Ladies and gentlemen of the crypto space, we're live on a Tuesday at 11:29 a.m. March 2nd. Beginning of the week, start of the month. Pretty good thus far. We're going to take a look at some technicals this morning because the market is in a pattern that we've discussed, that I've tweeted about, and we're going to understand where we are in that pattern. Likely. There's no such thing as certainty. All there is possibility. And you can probably quantify it as probability, but I would like to approach the complexity of the decision-making process from a solutions-oriented perspective rather than the problem. That's an interesting thought, particularly because most people see like a crash and they try and position for the crash, whereas the crash isn't really what's important. It's what emerges after the crash. So instead of focusing on the problem, focusing on the solution, I think sounds one, more optimistic, two, has longevity because crash will take time to play out, and then what happens afterwards. And if you're prepared for afterwards, you don't really have to do any work during the damn crash. Food for thought, food for thought. ABC correction, does it matter? That's the topic of today. Today's episode is sponsored by Change Angel, the non-custodial swap exchange for social goods. Stop depositing on exchanges, not your CREs, not your crypto, non-custodial DeFi, or nothing at all. Bam. Let's pop it over to the main screen and see who's in the stream. Bobbins in the house, always a pleasure. FSL, yes. Igor, Wave, Lewis in the house. Protect the downside risk before the downside. Protect the downside risk. That's right. Well, the kicker is in traditional finance and obviously in the crypto space, status quo is buy low, sell high. And how do you protect the downside? You sell high, and what are you going to short on the leg down? What a mess. You're trying to time the market, trying to figure out the price action. You're going to look at technicals. You look for moving averages. You're going to look for trend formations and other and price action support and resistance, and you're going to kill yourself over it. And traders lose their hair, and they also lose their shirts sometimes. So I need to handle things from a different perspective, and that is what I overwhelmingly focus on with the stream. How to approach value allocation not the way most people do. And that allows me, one, greater peace of mind, two, is the thought that if you're not doing what everyone else is doing, technically the odds are you're going to be more successful because that is just the way it is. Most people lose money. So if you're not doing what they're doing, you're probably going to do better than lose money. Let's see if there's anything in the Twitter stream that's worth mentioning. And then we're going to look at the charts real quick and I'll go into the concept that's on my mind. Great TA. That's decent. It's good TA. A lot of other folks do good TA. But TA doesn't tell us everything, and that's the whole point of today's stream, the topic. All right, so Ethereum, folks would freak out when you see this wick down below support, and I myself got tempted, and then I reminded myself of the strategy that I want to pursue. So we got the short time frame inverse head and shoulders. We got the trend line support, which wicked down seriously, but actually held. Stoke is completely oversold on the 30 min. If you notice, is it the 15 min? Yeah, the 15 min. So it's the back. Back. Computer froze. That was really weird. But I'm thankful the stream is still live because I really don't want to reboot the computer and figure out how to reconnect the damn stream from that position. That'd be a hot mess. All right, so let me look over some stream comments for a second, then I'll continue with the TA and whatnot. Williams in the house, always a pleasure. Stelios, yes, what is ABC correction? It's an Elliott wave theory where you have a leg down and then a half a bounce up and then a giant wave down lower than the original depreciative price action. So in Elliott wave theory, basically it's this. So if this was if this is going to comply with that type of pattern, you're going to do something like this. Somewhere around there. And then you can have a fat leg down to something lower. So you're probably talking about the 100 SMA. So I don't think we're going to have that, you know. A lot of folks do. And, you know, to me, it doesn't matter. It may do that, it may not do that. And a lot of folks would try and would be tempted to sell here to protect the downside. And I've been sharing with everyone the different approach, you know, protecting the downside vis-a-vis LP positions, particularly stablecoin paired positions, which are going to mute downside depreciation and also mute upside appreciation in favor of yield and a recurring revenue stream, which is basically a salary and putting your money to work. And last night I was tempted because I was thinking about the ABC correction, and you know the gamble, the trading is more risky than just sitting in an LP position and getting a salary. So the gamble is you sell here, you let it rip to 1100, and then you buy. So you're going to double up, you know, 30% on your Ethereum. And I don't have time for that shit. Can I get a confirm that the video stream is actually working? I got a yellow orange message, but you know, I'm just going to keep going. Let's see what happens. Um, Managing risk, name of the game. That's right, Carlos. Bavin, status quo in crypto, protect downside with LP positions and risk on for staking farming. Well, that's not status quo. That's basically DeFi new school action. So that's the way that works. Lewis, stake for yield and for risk hedge. Yes. So risk hedge, as I said, stablecoin pairing has an inherent downside protective capacity to it. And that's kind of like an option straddle combined with a dividend bearing instrument. Excellent, Lewis. Thank you very much. Let's keep it going. So, Noah, can you provide an opinion on Pool? Pool is cool. It's brand new. I just looked at it 2 seconds ago. But it's a lossless lottery, so that's interesting. For me, I want a salary. I don't want a lottery. So I want predictable income that comes in on a daily basis. That's a different ball game. You know, those are LP positions. You're talking about Uniswap, 1 inch curve, even balancer comes in weekly, but those are the types of positions that are sushi. That's what I'm more interested in. John, Noah, risk on or risk off? Developing my risk management philosophy with you, my friend. Risk on, risk off. So, you know, with regard to LP positioning, you still have a balance. You have risk on and risk off as well. So the dollar stablecoin pairing is going to be significantly more risk off. You're going to get probably less yield as compared to a double volatile asset pool. Like if you're doing 1 inch Ethereum, those assets are volatile. So they could both go up and down. Whereas with the stable pairing, the stable side doesn't go up and down. So that helps stabilize the pool, at least the dollar valuation. Now that's interesting. You know, a lot of people say they think in terms of Bitcoin or they think in terms of an asset, and they're not thinking in terms of dollar denomination anymore. And, you know, I agree with that in many regards. I agree with that in terms of Bitcoin for value storage. But if you could convert your volatile assets into a salary, what matters is your weekly salary, because if you could replace your weekly dollar denominated salary from work with putting your money to work, that's the baseline for measure of where you are versus where you need to be in order to achieve that degree of success. To make the same amount of money weekly, using your money to generate money as compared to exchanging time for money. And that's the trade-off. And that's the ultimate achievement in many regards of capitalistic freedom. Yeah, FSL, the entire computer froze. That was really weird. But everything looks to have unfrozen. Really didn't want to restart the damn computer. Stelios, could you do a TA for the Rook Eth pair? Can't see any patterns here. I'm not even looking at that right now. It's a completely risk-on position, and you know it needs there's some necessity what Rook needs to evolve into is it's still highly speculative because there's nothing that's drawing in or keeping a person in. It's an inflationary. There's no burn component necessarily. It's not as mature as obviously the established major DeFi protocols. Um, as I always said, risk on should be a small percentage of your portfolio. If something pulls a 10x and you turn 1 grand into 10 grand, that's crazy. If you turn 10 grand into 100 grand, come on, that changes everything. So risk on is a completely separate concept. Like full risk on, like naked risk on, is a separate concept as compared to liquidity pooling. Now, if you're going to hold an asset like Rook, you're probably going to want to put it in Bancor because now you're not only are you going to be risk on, Bancor single-sided pools are risk on, full exposure, full upside, full downside, but you're also going to be generating additional revenue on top of just holding the asset. So just remember that if you're risk on, you want it to be the smaller percent of your portfolio, and as you get success with your risk on positions, that's how you accumulate more and more principal that you could risk off to protect your capital and use it to generate a recurring revenue stream. You want to replace your salary. You want to put your money to work and turn it into an employee. That's the name of the game. Vincent's in the house, my man. Good to see you. Nice to make a live stream, not love. Dr. T, I remember that. My man. Matt's in the house. Class is in session. I think we're getting somewhere. I think we're starting to see different choices being made, and that's refreshing. No more buy low, sell high. No more just holding or hodling. That's how portfolios get destroyed. Um, and you know what it is. It's not about going a 10x on an asset that just deserves to go 10x, like Digibyte, for instance. It deserves to go 100x. The problem is, once it goes 100x, unless you're preparing now to know what to do and how to handle the finances, you're not going to know how to handle them. And this is why I like to say no matter the size of a portfolio, it's imperative to get these types of patterns, these types of self conversations going. So even if you have a tenth of the size of the portfolio as I do, you structure it properly. And if you want more principal, it doesn't mean you take more risk on. You have to always respect the risk off. The vast majority needs to be risk off. And if you want more principal, sure, you have your risk on positions. Turn $100 into $1,000 if you get lucky, $100 into $300, $400, $500, and you accumulate your principal. But you're working. I'm working. I'm at work right now. Go figure. So that's where you get your principal. And you turn that 50, 60, 70% of your weekly salary into principal. And let's say you just convert them to USDC and you get 30% on your money. Every week you're getting 30% on the money. Every week you're getting 30% of the money. And that's how you grow your principal. And sure, it might take years, but that's your path to freedom. Why not pursue it? So, obviously we get into the complexity of social norms and status quo and living standards and everyone wanting to keep up with the Joneses and whatever phrase comes to mind. And sure as hell comes to mind when I think of family members and younger cousins in their 20s. And I'm like, you're never going to stop working. You're always going to have to work because they always have a new pair of Gucci shoes, and that shit is not going to work. That is crazy. Kids empty their bank accounts. They literally get money and they spend it on depreciating assets. Accumulate appreciating assets. And even more than appreciating assets, yield bearing assets. So you don't have to work. That's crazy. Let's keep it going. Bhavin confirmed that was the audio cutting out. Thank you very much. Dr. T, yup. Matt, redacted. Iran, follow Noah Paradigm, took single-sided Rook LP position at Bancor. Sure. So bear in mind, it's still a risk-on position. Rook will appreciate to the upside and to the downside the full amount. Now, the vast majority of my Bancor positions happen to be stable coins because I don't want full risk on positions. I want risk minimized positions. Now, bear in mind, that's also for me because I've been successful over the last year and I want to protect my capital rather than grow it. I actually want less gains. I want to take less risk to achieve less gains. I just don't want it. I don't need it. I want to protect what I have. And bear in mind, I took a significant amount of risk to get what I have. So I appreciate Bancor, and I do have plenty of positions in Bancor, and there are assets that I likely will acquire and put it in Bancor for a single-sided LP protection, which would be a full risk-on, interest-bearing position. And that's the purpose of it. And no one else other than Bancor has that kind of position available. And that's extraordinary. Um, but and frankly, I'm actually not full risk off at this point. Yesterday, I was full risk on at a double, well, not it's not risk on, mid risk on because I was almost entirely in a double volatile LP position, two volatile assets. And the market has been doing some questionable things. Let's zoom into the 30-minute on Ethereum. I'm following Ethereum more so than Bitcoin for the last day or so. Because for me, Bitcoin kind of just sits, and I use Bitcoin for cash debt. I'm going to be using Bitcoin to pay taxes. I borrow dollars, and I use yield to pay back the loans. So look at this. We just had a mean regression to the 200 EMA on the 30-min. How do you like them apples? Let's zoom in. I didn't expect it to get below the guppies, but all right. There's your blast down. You know, you're going to see some bearish action if you get below the 100 SMA and the 30 min. That's going to be pretty brutal. Daily breached the 200 SMA and the 30 min. Let's take a look at the 1 hour real quick. Yeah, you get below that 50 SMA on the hourly and the 100 SMA on the hourly, it's going to be pretty brutal. But bear in mind, look at this. You notice on the 1 hour, you're not below the guppies, and on the 30 min, you're on the 200 EMA. So that's how these time frames overlap, and they give you better perspective. You get more detail, obviously, as you go to the lower time frames, and you get bigger picture as you go to the higher time frames. You know, based on this, there's a good chance that this is bottom. What you would want to see really is it bounces back in above the guppies because clearly it's still in the guppies here. And I'm hopeful for an invalidation of the larger ABC correction pattern that JT's been talking about, which I agree with. And invalidation is probably above this green line. If we blast through this green line to the upside, not there on the 4 hour, you got to get above the 200 EMA on the 4 hour. And then you got these massive, the 200 SMA and the 100 SMA on the 4 hour. And these are coming basically straight down. So you want to see the flattening of the long-term moving averages and frankly the upswing. So the 200 SMA is still in an upswing, which is actually still at least comforting. But the 100 SMA with the steep decline is a bit disconcerting, and the 50 SMA is basically falling off a cliff. So we're in precarious territory. There's no reason it can't go down, but this goes into the topic that I've been talking about and me thinking last night, should I liquidate and wait for it to get all the way down to the, what was it, the 100 SMA on the daily? And I reminded myself that I don't have time for that shit. I just don't. And I don't care because what I want is the weekly interest. And during times of volatility, that weekly interest is actually going to increase. I need that weekly interest because I'm going to be using it to pay taxes, pay bills, buy food, groceries, toys for the kids. It's the salary. So, how does that contribute to how you think about principle? And how does it contribute to how you think about money and value that you've worked hard to accumulate? And these are very profound questions that are not trivial and they're meaningful to think about. And everyone's going to have to come up with their own framework on how they approach their choices and decisions. And these are not easy choices and decisions because you're dealing with money. And that's why I feel I don't tell anyone what to do. I'll never do that. But I will provide and share my ideology, my concepts, and always advocating for protecting what you worked your ass off to acquire. BTC is playing with the downside move right now. Yeah, I'm seeing that on the Ethereum chart. It's the same thing. I mean, both of them are going to pretty much be lockstep and tandem. So there's a 50 SMA mean regression on the hourly for Bitcoin, pushing back up above the guppies, short-term moving averages. And let's see if it gets back above the 200 EMA and the 200 SMA. We're about to have a bearish cross. So, JT's probably right. And we'll get a fat ABC correction. I have no capacity to liquidate Bitcoin. Those are in CFI. You know what I mean by CFI, BlockFi and Celsius. So it's not even an option on the table. So I watch the numbers go down. We know where Bitcoin's going. And in the process, CFI is giving me interest. And when I need it, I can borrow dollars against it. It's all good. You have to retrain your mind. Downside isn't as bad as people think. It's bad in that if you buy $1,000 and you have $500 and you sell it, and now you're operating in a cash world, all you think about is dollars, and literally like, I'm never touching that again, and you just lost $500. But if it drops from $1,000 to $500 and you're getting 30% the whole way, and then it goes back up to $1,000, back up to $2,000, and you made 30% the whole way, did it really matter that it dropped? Just have to get over the emotions of it. I mean, if Bitcoin goes to $300,000, $400,000, $500,000, do you really care if it drops back down to $150,000? I'm just saying. You see what I'm saying? It's kind of like what happened last week. Probably down about 20% total portfolio from last week, but that was like blow off top type stuff. The market was exuberant, irrational exuberance. NFTs were popping, everyone with laser eyes. It's just gonna go up, up, and up. Well, yeah, that didn't work out. So, it was some savvy trader probably pocketed 1,000% on a 10x long, and then another 1,000% on the dip from 58,000 to 42,000. Maybe if I was 22, I'd give a shit. I don't have time for that. Matt hooking it up with $10. I really appreciate it, my man. FSL regarding pool. I mean, don't you have an opinion on the governance side of things? Sponsored by Coinbase. Yeah, it's pretty cool. I like it. I wouldn't allocate value to it. I'll maybe throw value in the pool, but that's gambling. I want predictable weekly income. So bear in mind, from a technological perspective, it's superior than lottery. It's lossless. Whoever the heck they are genius. Came up with a crafty product. Lottery is very popular. People like to gamble. And it's not really gambling because it's lossless gambling. It's only win. But it's not bankable. It's not predictable income. It's not guaranteed cash flow. So that's okay. Let a people like that, and everyone's going to have their own value allocation thesis and philosophy and framework. As long as your value is secured in the platform, the protocol has proven itself, all the merrier to have more and more protocols. Now, interestingly enough, DeFi is Legos. Plug that Lego into some other DeFi protocol, and now you got reward winnings. You have winners, random winners. So it's fascinating. It's fascinating how DeFi is going to play out with its composability, as they call it. Bavin, what do you think about providing liquidity on a layer 2 protocol, a quick swap, less liquidity, but you're able to farm quick token and can provide safe pairs like WBTCW? Yeah, well, L2s are a big deal, but I'm looking for better interoperability. Once you're operating on an L2 and you don't know that it's an L2, then we're all good to go. Probably the best potential right now is synthetics. Not from a technology standpoint, but because when you go into synthetics, it's an ecosystem. But like an AMM, sure, L2 AMMs are cool. But I don't want to stay in an AMM, an L2 AMM. I'm not a trader. I want my stuff on L1. The biggest problem with L2 is that it's not L1. So that seamless interoperability is mission critical. for L2 to, I think, have the full extent of the impact on L1 that everyone wants it to. How it plays out, I'm pretty sure I can't see yet. But I know between Andre and Julian and the boys at Curve and Charlie and all these smart boys in Bantech, they're going to probably come up with something that I cannot technologically think of because they have their head deep in the code. They know how the contracts work. They know the new features and functionalities. They know the recently deployed EIPs, Ethereum improvement proposals, and they are basically driving the evolution of these markets. So I'll be surprised. I'm sure I will. With the emergence of technology and platforms, DeFi platforms that I didn't think of. Here's an example. Alchemix. This thing is really cool. I just saw this. I think Julian may have tweeted it. So you deposit DAI, you're able to borrow against your DAI, and clearly you get 14%. But if you borrow, it automatically repays your loan. Here, check this out. Farm. Transmit. Where did it say? Okay, so basically, this loan automatically gets repaid by the interest that's produced by Yearn vaults. Food for thought. DeFi has auto self-repaying loans. That's crazy. So this is really cool. And she's totally up on the lingo. I forget who it was, but point being, you can just search for it on Twitter and you find whom creates it and you can follow her. And they're all characters. All these DeFi people are characters. And this is not a trivial implementation. This is a DApp coupled with obviously a custom smart contract deploy. Albeit it's not too difficult. You have a token mint. You have a urine interaction. You have a debt system, and it's I could probably envision high level how to do it. Not too savvy with the contracts, but conceptually it makes sense how these puzzle pieces are put together in order to provide this functionality. So this is a cool platform. Very interesting what she built. Uh, Julie Young's in the house. Always a pleasure. Noah, considering you have evaluated Bancor's AMM model quite extensively, would you feel comfortable adding more risk here? Are you happy with a smaller allocation? So Bancor, from a protocol perspective, I have a great deal of trust in their intellectual capacity. Now, if you're doubtful in any regard, you go over to Nexus Mutual and you get yourself an insurance policy. I don't think there's anything available for Bancor at the moment, but you could get quotes. Oh, there's plenty. 1 inch has quotes. They got cover for Curve at the moment. Bancor is not available, I don't think. Let's see. Yeah, they don't have any space available, but you can get Curve insurance. You can get Yearn Idle V4. Yearn offers insurance yearly. No. Here, Sushi Swap V1. Aave V2 insurance is pretty interesting considering they have the security module. And what the hell do you got insurance against Coinbase and Gemini for? That's strange. Celsius, that's decent insurance. I mean, I guess Gemini does offer lending at this point. Hey, look, keep her down. Cool. Smart contract. That's pretty cool. F2.0 insurance. There's a whole lot of insurance you could buy. Ren, I would imagine it's Ren VM, or at least all the contracts. Synthetic. Look at these. This is pretty cool. Hey, look, you could even get insurance against pool. How about that, FSL? You could even insure your pool position. So that's the name of the game. So I'm quite risk on actually at the moment. I'm in a double volatile pool predominantly. I have a good position in a stablecoin pair pool as well. I have a lot of stables. I have stables in Curve and Bancor, as well as cash that I build up, and that's my salary. And that's the way I've been strategically managing and handling the portfolio nowadays. Much less gambling and much more like it's an employee and I'm putting it to work. And I'm trying to minimize my risk so the employee takes home a good salary and is able to pay the boss. Something like that. Macro mind, the yield on VE curve has drastically changed. What does this mean? Well, the yield on VE curve is spot, and I think they changed it to a monthly average. So it varies. It's a variable yield. So let's scroll down. Let's take a look. Let's take a look. So I got a couple bucks in curve at the moment. And I have a couple of VE curve. Obviously I know the vast majority of you thinking, yeah, that's a shitload. So a lot of risk last year to achieve this. Yeah, but this is monthly average, 4-week average, 34%, and obviously this week it has dipped because we had a quite a notable risk-off event in that A wave down. Now we got a B wave up, so this contributes like this dip in weekly transactions, 104,000. Daily volume 211 million. Like during the depreciative cycle, this thing was doing 354, $500 million. And people are probably scared at this point, so they're not doing a lot of transactions. They're probably quite well positioned and risk off, and they're in stable coins, so they're not doing a lot of transactions on a day like today. The smart money already has reallocated to risk off. And for instance, myself, I'm hunkering down in LP positions. That's just the choice. And I'm fully prepared to know that it's going to go down, it'll come back up. Give it a month or 2 or 3. Comes back up. And the whole time I'm going to be generating yield. Probably more pronounced yield because LP positions will be liquidated, people will be selling and realizing losses for whatever reason they think is appropriate. Probably just their emotions make them think it's appropriate. So macro mind, yeah, so the bet with VE curve. So I like VE curve more than YVE curve nowadays. I know I did videos months back about YVE curve. But I like owning a piece of the DAO and having a capacity to vote because there's one thing I know about these DeFi protocols. This is just the beginning. Um, could you imagine curve in 1, 2, 3, 4, 5 years? And I'd like to imagine that in 1, 2, 3, 4, 5 years, this will be 2 billion, $20 billion a day, $200 billion a day. And instead of $19,000 a year, it's $1.9 million a year. So these are nice thoughts, and that's why I was comfortable in providing this kind of value. Albeit most of this was bought when Curve was like 80 cents. Now it's like $2 and change. But it's nice income, and I'm just going to let this sit here until it's reasonable to remove, because the gas fees are just huge. I mean, check this out. This shit drives me nuts, but this will build up over time. You give it 2 weeks, and I'll have a nice balance, and I'll be able to liquidate. But if you go over here, I have 99 curve that I could claim, but it's spread across a bunch of pools. I think I have some in 3 pool. Well, let's see. If I focus on just the GUSD pool, which is the only pool I'm in right now, let's see how expensive the contract is. Probably $200-300. Okay, it's $103. But yeah, that's the thing. If you click 1, 2, 3, 4, you can talk about $400 or $500 transaction. But if you go for one, it's $100. So, but that's cool. I mean, I have 200 and change. I wait for this to get up to like 500 curve. That's $1,000, and I spent $100 on the transaction fee. I had a whole bunch of chi up in 1 inch. So basically, that's like a 75% off transaction to get that into like USDC or GUSD. So that's not a big deal. Is it worth staking locking curve if not providing liquidity in any pools? Yeah, and that's the whole point of the weekly profit share. So VE curve's a big deal even if you're not staking. I'll show you guys what the deal is. So VE curve gives you 0.02% of transaction fees. So if this daily volume, if you see it spike to like $2 billion a day, VE curve holders are going to be happy and they're going to owe a lot of taxes. But with VE curve, you go to the DAO and you hit the calculator and you can figure out which pool you could apply a certain amount of value to. And it just so happens that I had enough capital that well, I actually had more, but I only allocated about 60-70% of it because I didn't want to max out my the allocation that I could put in GUSD pool. to get the max CRV yield. So if I put in any more stablecoins, I would have gotten less than 68%. I'd probably be getting like 40%. So by putting in less, I'm getting more yield, which is great. 68% on the money I put in there. It's incredible. Yeah, how much did I put in there? I put in 90 grand. I'm getting 60%. I'm getting 60 grand, so $60,000 a year. Nothing to complain about on that one, boys and girls. I'm sure most of you would agree. Yes, you make the more on the fees in the pools versus just locker. Well, both. You get the V curve facilitates the right side of this rewards API. Okay, so that's the way that works. And the more VE curve you have, the closer you are to the right side of these APY ranges. But you're also getting your weekly VE curve pool compensation. So you're getting this as well. So V curve has a twofold purpose, has significant deflationary pressure because as yields and liquidity has risen, people have to lock substantially more VE curve to get the right side of the yield range. And that's basically supply disruption, and that's what drove curve up to like $3 and change. Whole market's dipping, still a volatile asset. But I think these things are basically going to become the financial primitives, and they're going to be quite in demand, especially as they get to the nearer, closer to the end of the decaying inflationary emission cycle. I'd say they're probably going to keep some sort of inflation going because the deflationary pressures associated with the monetary policy basically make the incentives overwhelmingly sustainable, in my opinion. Nothing like traditional finance. Matthew, Alchemix is a beast staking AICX is paying around 1,600% at the moment. Yeah, it's because it's vertical. Dies. Yeah, it's having a hockey stick moment at the moment. So it's spot price. Okay, so that means pay 1,600%. That's over a year. The price action and the volatility is not going to last an entire year. So it'll normalize. So enjoy. And that's the whole point of the stream is to get you thinking about yield and thinking about not necessarily principle, or at least positions that protect the principle and allow you to reorient the way you think about your value as yield bearing and salary replacement and an employee. So you don't mind if your principal goes up and down, but what you care about is if you're making $2,000 a week. Volatile week, it goes up to $3,000 a week, and your principal is down 20%. How about that? If you got let's say 10, 20, 30 grand, and it's a volatile week, and you're making 30%, so the 30 grand, 30%, you're making 10 grand a year. Let's talk about it yearly for a second. So you got 30 grand, 30%, 10 grand a year. The 30 grand gets trimmed to about 20 grand. It's a risk-off event, but instead of 10 grand a year, all of a sudden you're making 15, 20 grand a year, and your weekly salary has increased. And then a month later, your 20 grand is back up at 30 grand, and you made that yield through the down cycle and through the up cycle. Yield. It's got to get over the emotions. Think bigger picture. Winner in training. Noah's Twitter handle seems to be at CryptoPimp. No, I kind of like the Noah Street bets for a little bit longer. I mean, the whole thing is we want to turn Main Street into smart money, and that whole Wall Street bets, they have no idea what they're doing. They're basically gambling, and they're going to lose all their money. And you've already seen some tragedies about people losing their money. Fuck that. What I do is not gamble, and I advocate the exact opposite, and I teach you guys the exact opposite. Don't gamble. What do you want as a revenue stream? What do you want is to not have to work. You want to work. So you really need that money coming in on a weekly basis so you don't have to work. And now DeFi has introduced financial tools and utilities that don't exist in the legacy financial system. You can't do this, but you can in DeFi. And that's why I focus on the topics that I focus on. Wave mappers are using any tools to track your yield across different platforms? Yeah, Zappervi. Zapperfi. I'm not going to go to it because I got my portfolio up at the moment. Zapperfi. See, Zapper.fi. Can't pronounce your name, but N3V3. How long do you lock up your curve? I do 4 years. I have no interest. So I told you guys I neglect the principal. I'm done with principal. I took a shitload of risk last year. Plenty of risk probably late in the year, December, and risk in January. And I still have risk on. And I got plenty of risk on positions. I'll give you an example. Cosmos, naked risk on. You can't do anything with Cosmos blockchains at the moment with regard to DeFi, but Cosmos is a yield bearing asset. Polkadot, can't do anything on Polkadot at the moment. Full risk on, naked risk on, yield bearing asset. I have Bancor, but it's full risk on, but it's obviously in the Bancor vortex, staked on Bancor. Yield bearing asset. Synthetics, DeFi, yield bearing asset. 0x, you can stake your 0x and earn Ethereum, yield bearing asset. Aave, you can stake your Aave in the security module, yield bearing asset. Band protocol, part of the Cosmos network. Stakeable, inflationary, yield bearing asset. Yeah, and I have older stuff as well. Blocknet has been killing it. Blocknet has been killing it. Up 50% today, 48%. Wow. That's pretty cool. So my favorites, IrisNet. I have obviously. The captain knows about that. He likes IrisNet, and IrisNet fits into the BSN and the China narrative on yield-bearing asset. What else? Kava, Cosmos blockchain, yield-bearing asset. Blocknet, service node, yield-bearing asset. Syscoin, masternode, yield-bearing asset. Zcoin, Firo, masternode, yield-bearing asset. StakeNet, masternode, yield-bearing asset. Every damn thing in the portfolio is a yield-bearing asset. Yield. I don't want to work anymore. I don't want to have to work. I want to work. I want to do what I want to do when I want to do it. And you're damn right I want to work. Wave, you're very welcome. I hope I help. I'm going to wrap this up in a moment. I've been rambling, but it's fun. Carlos, what's the best way to accumulate curve to increase your boost? Stake. You know, add liquidity. So if you don't have any curve and you have DAI or USDC or USDT or Ethereum, you can put it in the SF pool and earn 17% denominated in CRV. If you have Bitcoin, you can use the REN bridge and put REN BTC into the REN pool and earn 1.72%. I know it's a modest interest rate. Greater than zero, though. Yeah, look, WBTC, HBTC, there's increased risk, though, with I shy away because Bitcoin is precious. It's precious. So I take zero risk with my Bitcoin, and I consider the CeFi protocol as relatively risk minimized. And that's interesting. Does Nexus have? Tell me they have Celsius protection. Oh, that's fucking crazy. I'm so about to buy a position. Oh, come on. I can't cover Bitcoin and Celsius? Well, that's silly. What are they doing? That's unfortunate. Okay. Well, maybe it's just denominated in Ethereum. I'll have to look into that one. I am JD that still does not understand yield farming. Well, it's not yield farming. You're dividend investing. You're doing an option straddle. You are basically generating revenue. And this is what dividends do. So if you invest in a stock that's paying you 4%, you're going to get money every twice a year, once a year. Big O, Realty Income Corporation, will give you money monthly. They give you 4 or 5% per year monthly. You know what I'm saying? So it's dividend investing. That's exactly what yield farming is, with the crypto memes to be hip with the kids. But there's no difference. Actually, there is a difference. DeFi is nascent. It's has a vertical monetary velocity. It's working, whereas the legacy financial system is unfortunately failing. Maybe they'll prop it up. They'll throw around a couple trillion, 10, 15, 20, 30, 40, 50 trillion in the next couple of years, and they'll be able to stabilize it for a little bit until the Fed's able to get their digital currency online and somehow compete with China's digital yuan. Some serious shit going down, boys and girls. Where are you staking your ZRX? I'll show you guys. ZRX. They handle it all. It's internal. So you go to ZRX, let it load. I'll show you guys. While it loads, let's see. I need some advice. I started last year with 20K. We speak. My portfolio was over 400K. I took 50% out, put in the stable coins and 7% into Aave. Well, I can't give advice, but that sounds really good. I could give my opinion. Good for you. You did very well. Oh, is that 2,000%? Yes. That's a winner. Winner, winner, chicken dinner. Protect the shit out of it. Do you think it's good to put some profits aside? Or what is so here? So fine advice. What does put profits aside mean? Ask yourself the question. You made a shitload of money. The appropriate thing to do is to protect it. So clearly, Aave is very risk off, and if you want, you could get an Aave insurance policy. But Aave also has a security module, so it is self-insured to some degree. But you're getting about 5, 6, 7, 10% on average. I mean, sure, 400 grand, you throw it into USDC, and you get 40 grand a year. Heck of a paycheck. You might want more, and you might be bullish on Ethereum. Who isn't? So that's where like an Ethereum USDC pool would come in. And I think that those are reasonable. And you're going to get 60% on your money. And most incentivized pools, like 1inch, is like 60, 70% right now for Ethereum USDC. So you take 25%, 15%, 10% of a portfolio, and you apply it to a greater risk on position. The whole goal in your mind is you have to find what makes you comfortable. You want the vast majority of your portfolio to be risk off. How you define risk off is going to be subjective. Risk off for you might be Aave. Risk off for other people might be dollars. Risk off for myself right now is predominantly Ethereum USDC because I'm very bullish on cryptocurrency. And I believe what goes down will come up. We're in a bull market, and I'm not going to turn down 60, 70% yield. That's a massive amount of money. It's going to significantly appreciate over time. So for me, that's relatively risk off. So you have to define for yourself what risk off is. And over time, you might actually get more comfortable and start seeing slightly riskier things as relatively risk off as you get more comfortable with the protocols. But the appropriate thing to do, a fiduciary responsibility, is to full risk off and then go from there. So Aave is probably as risk off as you're going to get in the crypto space. This is basically like a bank account. These boys have their own internal insurance policy, and if you want, with that kind of gains, you go over to Nexus and you get another insurance policy and protect it even more. And then as you feel more comfortable with various protocols, maybe you want another insurance policy, you get a 1inch insurance policy, a curve insurance policy. And it's kind of like being in a cave for a long winter, and you peek your head out of the cave, and you're like, what's going on out here? So you start to figure out what the heck you can do, because this space is only maturing, evolving, and also de-risking. So done. The fact that you're thinking about risk, you're doing it right. Don't stop thinking about risk. Your job right now with what you achieved is to protect the crap out of that value and to grow it over time. Do not be naked exposed to volatile assets. Naked exposure, a full risk on position, you're really risking losing that value. What you want are positions that are protective of that value. So if they're going to depreciate, they depreciate for a period of time. The downside is minimized, like a dollar stablecoin pairing. Muted downside, muted upside, coupled with yield. That's basically my focus at the moment. So keep doing what you're doing, and don't do anything until you have a clear understanding of what you're doing. So go full risk off and peek your head out from the cave, and only make a choice when you feel comfortable. William, basically deposit coins and get money lending them. Correct. It's more than that though, because it's not only rehypothecation, which is what Aave is. It's a money market, a rehypothecation platform where you're lending your assets and people have debt that they owe you. But it's also these monetary policies that these protocols have manifested, and they're inflationary, and that's where the incentive comes from, paying 60% on the money. But to prevent the debasement, the destruction of the value of the DAO assets, they're coupled with deflationary components, burn components, supply disruption components. So these are far superior monetary policies as compared to what the United States federal government uses. The federal government is pure inflationary. There's barely any supply destruction, but Kyber has a burn component. Banker has a burn component. Um, Curve has a revenue share, which incentivizes the locking of CRV into the eCRV. So they have a significant supply disruption. So does 1inch. Significant supply disruption because you're not locking, but when you stake your 1inch, you get 35, 40% on your money. It's a volatile asset, but you're going to get 40% on your money, which is disrupting supply, removing assets from circulating supply. People aren't selling them. They have them in their staking position, getting their interest. And that reduction in circulating supply means people that want to buy have less supply to buy from. And that drives up price because that's basically a supply side imbalance. Let's go through the rest of the questions. I know I'm over today, but I want to get to everyone's questions. What happens differently to your assets when you stake versus when you're just an LP? So subtle distinction. You're staking as an LP. Well, I mean, LPs are facilitating transactions, a liquidity provider. You're talking about AMMs and Kyber's soon to come DMM, which is really cool. But you're facilitating a transaction process, which means you get interest. And then staking, if you're staking like in 1inch is staking, you're staking your 1inch tokens for a piece of the platform's transaction fees, whereas the Curve is not really staking. That's kind of really like a deposit because you can't take out your Curve and for 4 years. So that's just subtle distinction. You're talking semantics, Wave. That's just semantics. Jonas, thank you for the vids. Usually I just speculate on crypto like a degen, but I'm starting to think about how to rotate gains into income providing pools assets because of your vids. Thank you. And I thank you. Not just, I appreciate that. And I thank you for showing curiosity and wanting to do things different. It means a lot to me to try and make a difference because I've been relatively successful. And it's fulfilling to be able to help people. And this is my own way. Everyone has to find their way to try and help people. Some people donate, some people volunteer. And for myself, being able to understand these technological systems because of my engineering background and my understanding of the nuances and the software of these systems, I feel an obligation to be able to help. And it's enjoyable. And I like talking. It's kind of a curse and a blessing, depending on whether you ask my wife or not. You're welcome, N3VR. Done. My man. Smart. Be smart. Protect your gains. Cruz, love your stuff, Noah. 60% risk on, down to 20% says following you, but funneling the yields, risk on, LPing it, risk off. So it's trending in the right direction. Now you're talking. Look at those percent. Look what you're doing. You're now thinking about your portfolio as a structure with balance. How much risk are you taking? How protected is your value? And that's imperative. And there's no perfect answer. You have emotion. We have dynamic market conditions. We're always thinking how we could maybe get more gains and not risk too much. So it's all a very dynamic balance of shit going on in your brain all the time where your emotions jump in and fuck everything up. And that's really what happens. So just keep trying to remain rational, use logic, focus on rules, define your own rules, and don't violate your rules, and you will do the best. You might not get everything right, might incur some losses, but if you follow the rules, you at least followed your own rules, and that means a lot. Thanks. I figured it was a bit of that, small differences based on platform. Yeah, semantics. Macro Mind, before you go, what do you do with YVECRV? Nothing. I don't use it. I use VECRV. A lot of people like YVECRV because they can liquidate it, but I don't want to. I want to focus on my structure, and that's just the way I view it, and that's the way my rules, and I don't want to liquidate it. I want my VECRV. I want to be making $1.5 million in 5 years per year because that's what I think Curve is going to be. And that's why I've allocated that value to a non-removable position, which I think should really get some different tax treatment. Of course, the IRS, what do you think about YVECRV? You think you can't remove the damn position for 4 years. It's got to mean something. But no. Don, do you think 1inch will prolong the current LM rewards ending on March 9th? Unknown. We'll see. But between now and then, there's a lot of yield up for grabs, and that is something to consider. Every opportunity is important. The only bad opportunity is a missed opportunity. Consider your risks, make rational decisions, protect your value, take intelligent risk on, and always know that a risk on position carries a chance of loss, whereas a risk off position carries basically no chance of gain. And that's the whole balance. You're going to make 5, 6%, 10% on the Aave position. Lovely. Not really going to retire. Fine. If you got 2 mil and you're making 10%, you got 200 grand a year. Probably doing pretty good. Most people don't have 2 mil. And you're not getting 10%. Maybe that's on average, but still, just saying. Balance. Define your rules, stick to your rules. See you tomorrow, J-Ram. Yeah, I've been really over today. It's been an hour stream. Thanks, Noah. Radio Pool here from Twitter. Finally made it a live stream. Dr. T in the house. All right, I got to wrap it up. 40 people on the stream, 26 likes. We can do better. Tuesday, 12:27 p.m., March 2nd. As always, I thank everyone for joining. I will see you tomorrow. It's the start of the week. Tomorrow's Wednesday. We got much more to go. I will see you then. Peace.